Hello dear students, good morning to all of you. As we have started the term business services, and in this term we have already discussed the first kind of business services, that is banking. Now today we will start the second business services, that is insurance. So first of all, before starting the terms of the insurance or the services which are going to be provided under the insurance, first of all we have to learn about the term of the insurance or the meaning of the insurance. So insurance, in simple way, we can say to insure the people by providing such kind of facilities for their benefits. So in the term of insurance, insurance is a contract under which one party, it means insurer company, matlab it means the company who are giving insurance, that is known as insurer company. So insurer company agrees in return of a consideration. Consideration means insurance premium, to pay an agreed sum of money to another party. It means insured to make good for a loss or damage or injury or something of the value in which insured has the financial interest. As a result, some uncertainty event arises. It means, in simple way, we can say that the insurance is the process or a kind of contract or the agreement between two parties in which the person or the company, it means the insurer company, is going to agree or going to insure the people, it means the person who are going to be insured for their goods or for their lives, that if any uncertainty arise, the insurer company will help them in that uncertainty period or in that uncertainty event. It means insurer company is ready to pay the loss, and for this purpose they are going to get a kind of consideration. It means insurer company gets a kind of consideration amount, and that consideration amount is known as insurance premium. As we know that in our family so many people are insured or have taken the insurance policy from the different companies. These all are for saving us. These all are for saving us. Saving us is, it does not mean that insurance company is going to save you with the danger. It means if any uncertainty arise, after the uncertainty, insurance company will take care of your financial needs. So if any financial needs or supports are required, the insurer company is going to protect your financial needs, going to satisfy your financial needs after the uncertainty of the event. So insurance is the basic way today which are accelerating the people, which are encouraging the people to start the business and to accelerate the growth and development of the business. In previous term, when insurance company was not there or the facility under the insurance company was not effective, or we can say was not approachable, or was not performing the active role, or the people were not knowing the terms of the insurance, then for commencement of the business, first of all they were afraid of the losses or uncertainty in the business, and due to this uncertainty, they were not able to accelerate their growth and development of the business enterprise. So under the insurance, now the people are ready to take a kind of risk because they are thinking blessed that insurer company is there after them, who will promote or who will protect them with the protect them financially if any uncertainty arises in economy work. Now, for insurance, there are some insurance principle. So dear students, today we will study the principles of the insurance, and these principles are very much helpful for knowing about the terms of the insurance well. So first principle is utmost good faith. It means the insurance contracts are based upon the mutual trust. If we do not have the mutual trust on particular company, especially with the particular insurance company, we are not going to insure ourselves with the particular company. So for example, today most of the people are going to get insured under LIC, Life Insurance Corporation, and as we know, LIC is the most biggest firm of India which is providing insurance to each and every people, especially it is related to the life. So we have the trust. Until or unless if we are not having the trust with LIC, people are not going to create a kind of contract with the LIC for saving their lives or for getting the economic help after them if any uncertainty arises. So it is created due to mutual trust and due to good faith. Until or so insurance contracts are completely based on mutual trust, confidence between insurer and insured, or it is a condition of every insurance contract that both the parties, that is insurer or insured, must disclose every material fact and information related to insurance contract to each other. It means the insurer company has to disclose each and every required information and each and every terms of the policy if any terms and conditions are there, and the insured person has to also disclose the material fact related to their income and something else, that how they are going and how much they are capable to afford the insurance premium. So this can be created due to mutual trust. If the insurer is going to insure the person, then the insured person must have the mutual trust on the insurer company. Until or unless the insured person is not having the good faith or trust on the insurer company, then it is quite impossible to create a kind of insurance contract. Now next term is insurable interest. It means in the term of insurable interest, if we are talking about the insurable interest, it means it is a kind of, it means some precautionary interest in the subject matter of insurance contract. The insured must have the insurable interest in the subject matter of insurance, that is life or property insured. The insured will have to incur loss due to this damage, and insured will be benefited if full security is being provided. A businessman has insurable interest in his house, stock, his own life, and that of his wife, children, etc. So insurable interests are completely related, that which part of the insured persons are going to be insured. It means if any person is going to insure their life, then if anything happened with the life, then a risk cover will be with the life, and the nominee will be benefited. And if the assets are or stocks are going to be insured under the insurable interest, so if any damages arises with the assets or the stocks, then the insurance company will reimburse the amount of the loss of that particular assets. Now next is indemnity. So third term is indemnity. In the term of indemnity or principle of indemnity, it is applies to all contract except the contract of life insurance, because estimation regarding loss of life cannot be made, because no one can decide that when the life will be end. It is the subject matter of the diet, it is the subject matter of the health and the situation and the condition of that particular human being. So the death date cannot be decided, estimated life tenure cannot be estimated. That's why it applies the principle of indemnity, not guarantee, because no one can give the guarantee of the life. So the basic objective of the contract of insurance is to compensate the insured for the actual loss he has incurred. These contracts provide security from loss, and no profit can be made out of these contracts. It means if any loss arises, the insurance company is ready to compensate the losses due to the contract. But if the loss of the life is going to be held, this cannot be secured. Secured means what? Secured means life cannot be secured, but life, in the case of death, compensation can be given, but the same thing cannot be returned. As in the case of assets, same thing can be returned, but in the case of life, if any person is going to be dead, then that person is not going to make them alive. It means the person is not going to make alive by the insurance company. Next is proximity causes. So in the proximity causes, the insurance company will compensate for the loss incurred by the insured due to the reason mentioned in insurance policy. But if losses are incurred due to the reason not mentioned in insurance policy, then principle of proximity cause or the interest cause is followed. It means if the reason of the loss are clearly mentioned in the deed or in the agreement or the bond paper given by the insurance company, and in that case if loss arise, then that loss will be compensated. But if the losses arise due to non mentioned term, and if losses arise, their proximity causes of the principal can be arise, and the insurance interest cannot be provided. Only few terms or few steps can be taken to satisfy, to help economically the people, but only at minimum level, not at maximum level. Suppose that if any loss arise due to any kind of if any fire insurance is taken and loss arises due to earthquake, then in that case, in the case of loss due to earthquake, this cannot be compensated by the insurance company. Now next term is subrogation. Next principle of the insurance is subrogation. This principle applies to all insurance contracts, which are contracts of indemnity. As per this principle, when any insurance company compensates the insured for loss of any of his property, then all rights related to that property automatically gets transferred to insurance company. It means, in this term, if insurance company is going to insure any person, and if the term of the loss arises of any kind of property, so the property right is going to be automatically transferred to the insurance company, and they are going to compensate if it is required, if any losses arise of that property. Now next is contribution. According to this principle, the person who has taken more than one insurance policy for the same risk, then all the insurer will contribute the amount of loss in proportion to the amount insured by each of them, and compensate for the actual amount of loss, because he has no right to recover more than the full amount of his actual loss. It means, in the case of loss of any assets, only actual amount can be reimbursed, but not more than the actual amount. Now, the next principle of the insurance is mitigation. Under this term, or according to this principle, the insured must take reasonable steps to minimize the loss or damages due to insured property. Otherwise, the claim from the insurance company may be lost. It means, if the insured person is not going to take reasonable steps to minimize the loss, suppose that if they are not proper taking care of the particular assets, they are using or they are misusing that particular assets. Suppose that if any vehicles are not going to be, if the vehicles are not going to be locked, if the vehicles are insured and that vehicles are going to be left each and everywhere with that keys, and in that situation, if the vehicles are going to be theft, then due to not taken the reasonable steps for minimizing the loss, due to carelessness, it may consider that the person is involved in the kind of loss, then the insurance risk will be damaged and they cannot complain the insurance company to fulfill the risk or the loss. Suppose that if any person is secured his or her life and they are trying to commit suicide, in that case they are engaging themselves, they are initiating themselves to create a kind of danger for their life. In that case, insurance company will not compensate the loss. Now, as we have discussed the terms of or the principles of insurance, now we will discuss about the types of the insurance. So under the types of the insurance, it is basically divided in two parts. First is life insurance and second is general insurance. In short, LIC and GIC. Now if we are talking about the life insurance, so under the life insurance term, it is the kind of agreement between insured and insurer related to the life. It means the insurance company can pay some amount of the policy on its maturity or the death of the policyholder, whichever is earlier. It means suppose that if any insurance policy is taken by anyone for 15 years, and in the case of if that person is alive, the surrender value will be received by that person after 15 years, or in the case of death, whichever arises before. If the death is happened in the 12th year, then the surrender value will be received by the nominee of that particular insured person. So if the policy holder survives till maturity, he enjoys the amount of insurance. If he dies before maturity, then the insurance claim helps in maintenance of his family. So the insurance company insures the life of a person in exchange of a premium which may be paid in one lump sum or periodically, say yearly, half yearly, quarterly or monthly premium amount. So dear students, today we have discussed the concept of life insurance. Now we will discuss the next term, that is types of life insurance policy, in the next class. Till then, thank you.